Welcome to the weekly update, where I'll go over the action in the market for the week of June 17th through the 21st, and then we'll see how things look for the week of June 24th through the 28th. We did have only 4 trading days this past week. The market was closed on Wednesday for Juneteenth, but we still ended up having an up week overall. We're looking positive, but a little vulnerable right now. There's a lot of anticipation that in the short and possibly intermediate term, we're due for a pullback. Now, we're still seeing a lot of negative divergences on the daily charts. Some of those seem to be improving. We're seeing potentially some strength coming into the market, even though we had a down day on Friday. But we'll take a bigger picture look here and see what conclusion we reach. Before I get started, please know that I do videos every day. Now, I also have a program right now, and those videos that I do each day, they're not available until right when the market closes. I make them available to people in the program, which is free right now for the month of June, if you want to check that out. But then I upload it to YouTube and to Rumble, and I set a timer, and so right when the market closes, those videos become public. So you may find some interest in looking at those. If you want to look at them before the market opens or before the market closes for that day, you'll have to come over and become a member in the program. Again, it's free for the month of June. It will only cost you an email address. I do put a PDF available in the description below every video that I post. I go through tons of charts here. And some folks like to download the slides that you're looking at right now. They also like to download the charts, and they can look at them a little slower because I try to make these videos as short as possible since the videos are quite long anyway. I do post pivot points on the YouTube community tab. These can be very helpful. There are pivot points that last for the whole month. That's a daily chart, and I update it every day with the new candle for that particular day. Then I have intraday pivot points, and those I found to be very accurate and very effective. I update that every day, and those pivot points only last for that particular day, but feel free to check those out. I do have a private Facebook group. Not a lot of action there, not a lot of members, not a lot of back and forth. If you don't want to become part of the program, this will still be available to folks so we can have some back and forth. I'm an educator at heart, so even if you don't belong to the program that I have, I still want to try to help out and maybe have some discussions anyway. I do really watch the comments on YouTube and Rumble. I actually had some legitimate comments this past week. Apparently, they're not running their webinars right now through Fiverr or whatever company does this, but they put on these webinars and they tell people, come up with some type of comment, and then they just copy and paste it. They go through all these different channels. I delete those immediately because they tell me what great content I have. And I say, well, okay, if you're really watching my videos, I give you an email address and I tell you I'm going to delete those comments, but people still do it anyway. So that means they're lying to me, and I would never want to do business with them anyway. I do also post on Rumble. Periodically, I'll have trouble uploading to either YouTube or Rumble. That's why I use it as sort of a backup. Excuse me, I've been teaching all day and my voice is kind of starting to go away here. But here is a link to the Rumble channel. I also put this in the description below. If you can't find me on one platform, feel free to switch over to the other platform if you're looking for a video, and it should be there. I do have the program that is now launched for the month of June. I'm pretty much keeping it wide open. I'll be locking it down in July. So a lot of information that I share here publicly, I just keep for the program itself. And I'm going to be rolling out more information in July that is really only available to members. There is a link in the description below, both to take you to the SPXInvesting Program website, as well as to a video that talks about the whole program. And I do have a playlist on YouTube where you can go through some different videos that I made to check that out. If you want to email me about this, here is an email address. I try to stay really on top of that and respond in a timely manner. Another YouTube site that I would recommend if you're a longer term investor, if you find that the weekly videos that I do are about as far as you want to go, another gentleman named Chris Shavacco, he posts weekly videos as well. He's also a money manager where I'm an educator, and he has a lot of different things, a little bit longer term look than what I focus in on. I'm mainly looking at the long term for how is this going to affect the daily charts. He's looking at things in the broad picture because he does asset allocation and he goes in different markets, where I just focus on the S&P 500. Another YouTube channel that's probably worth checking out is a gentleman named Bob Kindle. He's been around a long time. He has some unique indicators. He has a lot of insight. And I don't recommend YouTube channels all that much. The two that are on here are ones that seem to be pretty good. There's other channels that I've come across from time to time, and either they really don't know what they're talking about, or they're only focused on being positive or negative, and that doesn't really help things because the market can do either one, or they start to give you information and it's kind of the same information over and over and over. So I found these two channels to be helpful. I watch them myself. I also subscribe to his newsletter. This is the banner page for his YouTube channel, so feel free to check him out. Let's go back and talk about what happened. For the week, we were up 0.61%. Not a real strong week, but it was an up week nonetheless. We were above average with volume. Now, a lot of that can be explained because of quadruple witching on Friday. It's the third Friday of the month, and we have stocks and futures, and there's four things. That's why they used to call it triple witching, and then a fourth thing was added later on. And it can be a pretty wild day. It can also be a very high volume day because we're coming up to the end of the quarter at the end of June here. Even with the one trading day less, we were still above average with volume there. We're still positive now when we look at our charts. There are always some areas of concern that we'll keep an eye on, but it's all about inflation and interest rates for the markets. What's going to happen with inflation, and in turn, what will happen with interest rates? The market is still anticipating that in September, the Fed may cut rates at that point, but they've been speculating about a rate cut since June of 2022, and it hasn't happened yet. So for right now, they're just keeping rates higher for longer. They're a little bit concerned at the Fed about inflation. They want it to come down to that 2% level. And for right now, they seem to be confident to keep rates where they're at. We don't even know if we're going to get a rate cut in 2024. At the beginning of the year, the market was pretty much anticipating 6, maybe even 7 rate cuts. Then that got whittled down to 3, and that was more coming out of the Fed. Now it's pretty much been whittled down to 1, and we don't even know if that's really going to happen or not. We want to keep an eye on the geopolitical events that are going on. Now, most things that go on in the world don't have a direct impact on the stock market, but sometimes they do. And that's why we keep an eye on the news and what's going on there, not only in the US, but globally as well. And then the condition of our trend right now, we're actually seeing it getting stronger. It's crossing back above its moving average. I will show you the chart of that. It's positive, and the green line is above the red line, and they are advancing. So the longer term trend has now switched over and is looking positive. Just some bullet points. The major indices or indexes, however you use that term, they did have gains on the week, even though it was a 4-day trading week instead of 5 days. The S&P did cross above 5,500. We actually opened above that and then kind of came down from that level. But that's psychological, and that could turn into a technical level at some point. The financial media loves to point out these round numbers and report on them because it's really easy for them to do. But we ended up closing below that level by the time things ended up on Friday. The markets were closed on Wednesday for Juneteenth, and Friday was quadruple witching. That produced just a huge increase in the volume that we see. And gains this past week were relatively broad-based. Now, the big problem, and you're probably hearing about this in other videos, and I'm showing this in my charts too, where it's just a few stocks that are really leading things higher. Well, this past week, those stocks didn't do all that well, and we still had an up week anyway. And that's one of the areas that I'm looking at of potentially some strength coming back in that's not just being led by NVIDIA and Apple and, the big companies that are really driving the indexes right now. The equal weight S&P 500, which treats all the stocks in the S&P the same, it outperformed the market cap weighted S&P 500. That one is weighted more towards Nvidia and Microsoft and Apple and Google. So when those stocks do well, that drives the S&P up. Well, the equal weight, it treats everything the same. And so the fact that it did better this past week just shows more broad market participation. And then some of the mega caps like Nvidia, it ended up being down 10%. Apple fell 2.4% for the week. Interest rates on the 10-year yield, we closed at 4.26%, and the dollar index actually rose. Interest rates ended up going up. This put some pressure on stocks. The dollar going up also can pressure stocks. So looking at the different indexes here, the Dow was up 1.5%. It actually was one of the better performing indexes this past week, where a week ago it had been really lagging for a considerable amount of time. We were unchanged with the NASDAQ. We were up slightly with the S&P, and we were up slightly with the Russell 2000 small caps. This is a chart that, yes, I've been showing this for over a year now because it's a very long-term chart. The orange area is kind of where we're at. And even though I've been showing this for a year, we're still in this area where inflation is continuing to come down, even though it has bumps up along the way. That's what we're keeping an eye on. This blue line is from 1966 to 1982. We've been tracking that kind of close. And for right now, for the last year or so that I've been showing this chart, we continue to track this fairly well. We could deviate away from this at any time. The thing that makes me keep showing this chart is look at what happened after that. Once inflation really bottomed, we just saw a massive pickup in inflation. Now, you're going to watch other YouTube videos and you're going to hear these people that are supposed experts on the economy and on the stock market. They're predicting this to happen. We don't know if that's actually going to happen. It might. There are things that are in place that could allow something like that to actually happen, but we don't know for sure how this is going to play out. We stuck with what happened in the past, kind of close, but it doesn't mean we're going to continue to go in that same direction. So in the meantime, we're just aware of this, knowing that after a period of really declining inflation, we did see hyperinflation going into the mid to late 70s, and that could happen again. And so we just want to be aware of that. Then looking at the RenMac research, we're above the 4.02% for the 10-year yield. We closed at 4.26% for the 10-year. When we get above this 4.02%, that's why we're seeing earnings per share. They're going up, but not going up as fast because companies are having to pay more because of interest rates now, and that bites into their profits and their earnings. Looking at some Isabel Net blog charts, this really hasn't changed. It was updated on the 14th of June. The takeaway from this, I put the red arrow on here. It just means that whether it's Morgan Stanley or the consensus, they're seeing earnings continuing to go up well into 2026. And that is giving a real solid positive backdrop to the stock market. And we look at the weekly equity fund flows. We did see some money coming in to equities, which means stocks. And then this yellow line is a 12-week moving average. So money is coming back in, and this usually is to buy. So that just gives a little bit more of a catalyst for prices to go up. We look at the truck tonnage index, and for a long time, going back to 2009 up to about the COVID crash, we saw the purple line, which is the S&P, and the yellow line, which is the truck tonnage index. They would pretty much go hand in hand with each other, but they are on different scales. We saw a real deviation where the S&P went up and the truck tonnage has been going sideways. This is not necessarily to predict anything. We're just seeing something different over the last 4 years or so than what we were seeing up until that time. And if this yellow line is going up, that means more people are buying big trucks. And so even though the transportation index is really lagging and has been for the entire year so far, that doesn't seem to have a real impact on the S&P, at least to this point. Then looking at the share repurchase over the last 10 years, and this is a cumulative, where companies have bought back 7.6 trillion in their own shares. And that tends to be a positive thing. When a company goes out and buys its own stock back, that makes so there are fewer shares on the market. So the shares that are out there are considered to be more precious. And then if a company is willing to go out and actually spend money to buy its own stock, they must really believe in it. But there's also some accounting manipulation that can go on with this. It can make their earnings look better because really they're getting earnings from their stock. So yeah, there's all these kind of games going on. But the takeaway from this is that this is seen a steady rise going back to 2013. Then looking at the inflow into tech funds. Now we're seeing money coming back into the market and we're seeing money going into different areas. This is a huge increase in what we're seeing going into the tech sector. That's because it's the darling sector right now, and everybody's talking about it that's involved in the stock market. Everybody's talking about NVIDIA. And a lot of times these folks end up getting late to the party. They put their money in just when things are about ready to end. We don't know. NVIDIA was down this past week, so those people that bought over the week are already seeing a loss. But we'll have to see if that ends up being anything that helps push the market higher since money's coming in. Then what is the biggest tail risk? What's getting in the way of stocks going up? It's still inflation, even though that's backed off. It's still coming in at number one. Geopolitical events are in number two. There is some concern about the US election and then whether we're going to have a hard landing, which means we go into a recession. Some kind of credit event, that means more or less the banking situation. And that could happen globally or that could happen within the US. And then this all bubble because things just seem to keep going up. Folks aren't as concerned about that. And this just shows you from June to May to April how this has changed. We did get the LEI. This is the leading economic index. It came out on Friday. And I showed that in the video for Monday, but this chart came up as well, where they put these red lines on here. When we drop below the red line, that means that there's a recession warning. Actually, we go below the black line and then the red line. Well, we haven't gone into a recession, at least yet, and now we're coming back above the red line. So even though the LEI was down 0.5% when it came out on Friday, the longer term growth rate here is going back up, and that suggests a more positive economy. Then looking at the prediction based on what they think will happen, and this is going to change all the time. There are 22% thinking that the Democrats are not only going to get reelected as president, but they're going to take the Senate and the House, where we're going to have a Democratic president, 22%, and a divided government, where we have a Republican president and a divided government. And most people think that the Republicans really have a shot at doing a clean sweep of taking not only the presidency, but both houses, the House and the Senate in Congress. This is just a prediction. We don't know what's going to happen. There's all kinds of things going on as far as polls and who's going up and who's going down and who's going to win and who's going to lose. This upcoming week, there is a presidential debate. It's on the 27th of June. Should be kind of interesting to watch that. It's also a very strange time for a presidential debate to happen because the conventions haven't even happened yet. Usually the debates happen after the conventions. And so there's a lot of, okay, why is this happening so early this time? Why are there so many strange rules? There won't be any people there in the audience. But it might be something interesting to watch. Then FactSet had one blog post. It says that analysts are projecting S&P to report double-digit earnings going out into 2025, 2024, and 2025. So these kind of grayed out areas here, these are projections going forward. And this justifies stocks going up when earnings are going up as well. Looking at our charts, first we look at an intraday chart where I start off on Monday, and this is only 4 days because of the holiday on Wednesday. We were pretty much sideways in Monday's session. Well, actually, let me drop back. We had a really solid up day on Monday, and that might have been some carryover from the weekend. A lot of folks are like, hey, let's get in the market. That was a really solid up day, and that's really where we saw most of the gains. It was on Tuesday that we pretty much chopped sideways. Then we were closed for Wednesday. When we came back on Thursday, we gapped higher. This is when we went above 5,500, but we didn't stay there very long. And then we spent the day coming down. We also gapped lower on Friday. We tried to make a run at getting back to positive, but then we ended up closing negative. So we saw the gains earlier in the week and then things pulling back later in the week. So just looking at the 4 trading days from Monday to Friday, taking out Wednesday, we had the Dow doing the best, which it's been under some pressure lately. And then the NYSE, this is a broad market measure. And the fact that it's doing better doesn't mean that there's just a few stocks that are really outperforming. The mid caps, which have been languishing, they were one of the stronger areas earlier in the year. Maybe they're seeing a little bit of favor right now, where the small caps, they're still struggling. They ended up being down. The S&P was down during the 4 trading days. We had the NASDAQ and the NASDAQ 100. This is the tech sector. The NASDAQ 100 has been the real darling lately. It actually pulled back this week. Going back to the beginning of the year, we still have the NASDAQ and NASDAQ 100 doing the best, followed by the S&P. The Magnificent Seven stocks are in, well, at least the first and the red one and the pink one here. I'm sorry, the blue one and the pink one here. They're probably in the red one too, but the NASDAQ 100 are the biggest stocks that are in the NASDAQ. And all of the other indexes, the NYSE, the mid caps, and the Dow, they're positive on the year, where we're still looking negative when we look at the small caps. Different sectors, we actually saw discretionary doing better. And this is an area that's been a disappointment a lot of 2024. This is more of a growth area where you want to buy low and sell high. It performed about the best, and it was up 2.4%. All of the different sectors ended up being up except for real estate and utilities. Now, utilities have been strong lately, but they did see some more profit taking this past week. On the next chart, I rank them a little differently. We go way over to the right. We look at the scooter score, and the closer it is to 100, the better looking that particular sector. We have the tech sector and communication. These are growth areas, and this is what's really been driving the market. They're into the 90s. Then we drop all the way into the 70s. And when we drop below 50 or 60, I guess here, this is where we start to see some more weakness. But we're not seeing anything red necessarily right now. It's more of a neutral type of a reading. Then going back and just looking at the 4 trading days for the week, all of the sectors ended up being up except for tech. We did see some profit taking there. Going back to the beginning of the year, tech is doing the best, even though it pulled back this past week. Communication is in second. These are the real growth areas of the market. The other sectors are still negative year to date. Here's our relative rotation graph, and I've been doing a lot more research on this, but I've been busy doing things for the program, so I don't really have anything new to share here. This goes back over the last year and looks at all of the 11 sectors. And if you remember back to your geometry class in high school, you have an x-axis and a y-axis. When we're up in the right-hand quadrant here, that's the strongest area of the market. The lower left-hand quadrant is the weakest area. Now, this goes over the last year. I'm not going back over the last month or the last week or anything like that. But the utilities have been strong, but now they're starting to actually turn back down. This other yellow area with energy, it's really coming down. You can see when it has a really long tail like this, that means that it's really moving down, and we're seeing more of a trend there. So energy's been seeing some weakness, and really utilities right now are about the only thing that's strong. The tech sector, yeah, it's doing okay. We're seeing it's coming back up and showing an improvement, and we're seeing a little bit of an improvement here with staples. That's more of a defensive area. What we want to see is the XLY, which is discretionary. We want to see that doing better. But the fact that tech and communication are holding up is looking a little better, where we have real estate, which still has been the weakest over the last year. Then I take that same chart and now I break it down more based on numbers, where we have utilities still looking the strongest, and then staples and tech. And then more neutral would be energy and communication. We want to see communication doing better. And then the areas that are negative, there's just a long list here. I'm not going to read all that off. All the other sectors. Now, when we go back and look at the different major indexes, and they're listed over here on the right-hand side, we still have the utilities doing well. We look at that separately here. I don't know why that's on here. I guess it's the Dow utilities. All right, never mind. Then we have the OEX, which is the S&P 100, the SPX, which is the S&P 500. The mid caps, this is the part I was talking about, where they have been showing some weakness. Again, this goes over the last year, so it would be nice if this was to turn and go back up. Small caps are still weak, and the transportation stocks are just not doing well these days. Here we have the NASDAQ 100 that has been coming back on and looking a little bit stronger. Here is a chart of how these look just based on numbers. Still utilities doing well with the OEX, the S&P 100, the NASDAQ 100, and the S&P. And then we have the transport, small caps and mid caps, which are negative, or the Dow Jones Composite, which is the Dow, the transports, and the utilities together. That's more in the neutral area currently. Looking at sentiment, this has been kind of frustrating because the S&P has been going up, the NASDAQ 100 has been going up, but sentiment has been going down. And a lot of that can be explained by the negative divergences that we're seeing because the components that make up this fear and greed index, they've actually been going down as the market's been going up. And that's why we're getting a really low reading here. We are still tending to decline overall. So that should be taken more as negative, just meaning that it, at least as far as the sentiment gauge, we're not seeing a lot of broad market participation. Now, if what we saw this past week continues with more broad stocks actually participating, that could end up turning this up. If we can get back above 50, that would turn this more positive. We tend to roll with this whatever direction it's going. So we're a little bit more negative as far as sentiment. When we look at changing our mind is when we get above 75, when we're overly optimistic, and we drop either near or below 25, that means people are really pessimistic at that time, and we could be seeing some kind of a reversal in the market. Here are the active asset managers. They actually tick down just a little bit, but they're not giving an extreme reading currently. And here is the reading of 85.26. They're above this 80 level. Not really extreme, but still looking fairly positive overall. This is the weekly chart of the VIX, where we are seeing fears coming back in. The line chart is going up, but we're still getting very low readings. Even though it's going up slightly, the VIX is just showing that there's not a lot of fear in the market. The Ulcer Index is going sideways, and it's below its moving average on the weekly chart. It's declining on the daily chart as the market has been holding up fairly well. This is the spread between risky and not as risky bonds, and then I have a breakout chart after this, where this continues to go down, so they're not really seeing a lot of fear in the bond market and the spread between the two. So we actually fell a little bit when we look at this, and this is inverted. This middle area is the chart that we just looked at, but then flipped upside down. This means that we're not seeing an awful lot of fear right now. And the reason why I flipped this around is we try to match up with what the S&P is doing. We also look at the VIX and flip that upside down, showing that there's not a lot of fear currently. So we're not really seeing anything all that alarming here. If anything, it could be considered a little complacent right now, that there's not a lot of fear in the market. Folks in the market are just assuming that it's going to keep going up, and the market doesn't like that. So if we see a bit of a pullback, you're going to probably see these charts continue to come down. Then we had the latest reading from the Investors Intelligence Survey that comes out once a week. We're a little bit above 3 at 3.42. The right-ex bear bull ratio, these folks are just getting knocked around all over the place. We have an up day, they go long. We have a down day, they go short. And then if the next day is the opposite, they're just getting whipsawed all over the place. We're coming in at a reading of 0.33 right now. 0.03, which just means that they're more into the bullish side of things rather than the bearish side. When this really goes up, that means they're into the bearish side. They're anticipating the market declining. The latest reading from the American Association of Individual Investors, we're coming up above this 20 level, but we're not necessarily getting an extreme reading. So we can kind of go with this for right now. And we're seeing the moving average, the red line here, it's continuing to go up. So we can kind of go with that as well. It's when we get above 30, and really when we get above 40, that's when we start to get rather nervous that folks are becoming a little too positive about things. This is kind of inverse to logic. When this is going down, that's actually positive for the market. We're comparing cash to the tech sector. And so when this is going down, that means cash is underperforming the tech sector, and that's what we're continuing to see here. So that's positive for the market. Looking at the latest readings of GDP, and we will get the third estimate of GDP coming out in the upcoming week. Probably not a huge event unless the numbers come in drastically different. We had the first reading, and that's what the market really fixates on. Then we had the second estimate, not big changes there. And then the third estimate maybe won't be that big of a deal either. But those numbers come in drastically different. That could really shake up the markets, either to the positive side or to the negative side. But right now they're coming in at about 3% according to the GDP Now estimate. When you look at the consensus, we're looking at about 2.5 to 2.75% on the upside, and about 1.25 to 1.5 to the downside, as far as what economists are predicting. This is showing this in a little different way. We're focusing more on this area. Again, what I usually say here is the takeaway is all of these are positive. They're above zero. When we see these go negative for 2 quarters in a row, that's one part that means that we're likely in a recession. Now, there's other things to define what a recession is, but a big one is negative GDP for 2 quarters. We're still going down here with the Chicago Financial Conditions Index. That is more positive. We get nervous when we go above the black line. This is a little bit old now. It was updated on June 7th, where we're coming up to this red line, but we're not quite there yet with the real-time SOM rural recession indicator. And I don't know why they call it real-time, because this chart's only updated once a month. And then we have another one called the Smooth U.S. Recession Probabilities. This is updated once a month as well. We're below the black line. If we get concerned, it'll be because we go above the black line and up above the red line, and we're not doing that. And then the Bray Butters Kelly Leading Index. This is one of those, it's only updated like once a quarter. So this has been coming down. If it was continuing to go up, that would cause us some concern. Looking at inflation, this is updated every day. It's Inflation Now casting, and we do see some adjustments as different reports come out. In the upcoming week, we are going to get the core PCE, and that's the real inflation area that the Fed really pays attention to. Speaking of the Fed, they're going to be meeting on July 31st, and as of Friday's close, there's an 89.7% chance that rates are going to stay the same. And if anything, we're showing a little bit more conviction here. The dark blue is where we're at right now. We have a day ago, a week ago, and a month ago. And so this has become even stronger that there won't be any rate cuts at the next meeting. Then we look out to September, and this is when the market is starting to anticipate that there might be a rate cut. And we're at 59.5%, thinking that we're going to get a 25 basis point or 1/4% cut at that meeting. There's still 34.1% that think that we're going to have rates the same as where they're at right now. There's even 6.4% that think we're going to get a 50 basis point cut or 0.5%. And this is where we're looking right now, not seeing an awful lot of change. If anything, this is getting a little more locked in. But this could change, and it's going to be dependent on what are the economic reports saying? What are statements that are coming out of the Fed? They pushed it back. It was going to be March, and then May, and then June, and now it's July, and then they're pushing it to September. Is it going to get pushed out even longer than that? Right now, the market doesn't think so, but if things start to shift economically, these numbers here, looking at a rate cut, will probably go down, and these numbers that think will stay the same are probably going to go up. But we don't know what's going to happen going forward. Here's a look at the balance sheet where it is going up. You can see we have a positive amount. This is updated every Wednesday. But when we look at this overall, it's still continuing to decline. And then I do a year-over-year change here where we're still seeing more things falling off of the balance sheet. See where it has a minus figure up here. We're waiting to see if the balance sheet is going to start going back up, especially on a year-over-year basis. And that means that the Fed might be in doing some buying, and the market really likes that, even though they promised 20 years ago they would never do such a thing. Now it's pretty much expected. Then looking at the overnight reverse repurchase agreements, this is way over here on the right-hand side, the latest reading. We just keep an eye on this. When this is really going up, that means that the Fed is a little more active. They've since been really trailing off with this, and we're continuing to go down and at worst kind of sideways currently. Looking at our breadth indicators here, this is based on price, where we're still looking positive, and we're also still looking positive based on volume on the weekly charts. We're still seeing a bit of a negative divergence on the daily chart, where it hasn't come back above the previous high, where we're staying right about at the previous high based on volume. That could be taken as positive. That just means that volume is holding up better. But eventually, we need to see price confirm that on the daily charts. We did see more of an expansion of the new highs rather than any new lows. We're kind of chopping all around here with our 4-week average as this is going up and down and all over the place. When we look at our 10-week average, we are starting to go back up, and this suggests more stronger term internal measures are positive. We're starting to turn back up with the advanced decline ratio, and we're still above 0. So we had been positive, but the fact that this is going up is more positive. And then this is a smart money indicator, accumulation distribution. We're looking pretty good on the daily chart, even though it declined slightly. We're looking even better here on the weekly chart. This means that the smart money is still doing some buying. The one thing that is a little bit of a concern is we're starting to get kind of far away from this moving average. And sometimes when we get far away, it has a tendency to come back to that moving average. Here's our trend where we're finally starting to turn back above the moving average. This means that the trend, which had been getting weaker, is now starting to get stronger again. The green line is on top, so that's positive, and the green line is going up. So we're looking pretty good there. When we look at the Erin indicator, this measures the buyers, which is the green line. They're pegged at the top. The sellers, that's the red line, and they're pretty much at the bottom. The oscillator in the middle, this is the difference between the two, and it's still showing a pretty positive reading. You could almost make a case that it's looking too positive, but we can stay up at these really extreme positive readings for a long time. The mass index is not generating a signal right now. Here's a daily chart where we're above the 50-day moving average. We have another trend line that we're kind of keeping an eye on here, but we really haven't challenged that yet. If we continue to go up, we do have some pivot points above current prices that may act as overhead resistance. On the bottom, you can see the massive spike up that we saw this past week in volume, and pretty much all of that came on Friday. So looking at the Keller market model, we're negative in the short term with the mid caps, where we're negative in the short term with the small caps, and intermediate term, where all of the other areas of the market continue to be positive. Stocks are positive across the board. We're still negative with bonds based on price. Everything else, commodities and the dollar, are back to looking positive. No changes here with the decision point scorecard. We're positive across the board on all the different time frames. We're still looking good here with the trend channel that we follow. We're well above the midpoint. This goes all the way back to 2009. Those were the lows that were set then. And this has been interesting, and I've actually been talking about this chart in the daily videos. We were able to get above this R2 level and actually close above it. These points can be rather important. We saw it was very important right at the end of 2021. It was also important in the summer of 2023. Well, we got above this R1 level, broke above it, and then came back down as we saw some weakness over the springtime. Now we've been able to get above this R2 level. The thing is, can we stay above that? And that could end up being quite positive for the market. But when we look at it on a trending basis, the 50-period simple moving average, that's the red line. It's going up, and prices above the red line, and both are going up. That's positive. Then I look at a moving average crossover here, where the blue line is above the red line and price is above both, so that is still positive. We look at the McClellan oscillator. After going down and being rather negative, it actually crossed back above 0. And we're seeing this on the daily chart for the S&P as well. This was a negative divergence that was causing us some concern. The fact that this is turning back more positive is a good thing. We look at the summation index, where we're still going down here, because this previous chart, whenever it goes above 0, that turns the next chart, the summation index, positive. It sometimes can take a while for this to actually kick in. We're still looking positive based on price and volume, even though these are still declining for the current time here. We look at the Swenlin trading oscillator. We're crossing back above 0 based on price. We're still just a little bit below 0 based on volume. This is also starting to turn back and look more positive on the daily chart. The bullish percent index, this has been a disappointing area. We're not negative since we're above 50, but we've been just chopping sideways for the last 3 weeks here. We want to see this really going up. This is not moving average based. This measures the point and figure buy or sell signals generated inside the S&P 500. So when the S&P is going up, we want to see this going up as well. It's just been going sideways, and that's a bit of a negative divergence, even though this indicator is still positive. And we're seeing that same reading on the daily chart. We look at the momentum. It's trying to turn back positive. When we look at the PMO, we're slightly below 0 based on price. We're slightly above 0 based on volume. So we're seeing a little bit of an improvement with the PMOs that are rising. The buy signals are starting to go up, and we're still flattening out with the PMOs above 0. The Bollinger Bands, this is a rare thing. We've seen it a couple of times over the last few years where we actually closed above the upper Bollinger Band, and that's what the percent B actually measures here. That could be a little bit negative because we don't spend an awful lot of time up here. You can look at other times when we went above this. It didn't necessarily mean the market fell apart, but it might be due for some sideways action. Here we hit it and we still kept going up, but then the Bollinger Band, which readjusts every week here, adjusts every day on the daily charts, this continues to go up and we were able to stay underneath that Bollinger Band. The momentum, we're turning back a little bit more positive in the short term here with the slope and the TSI. Also looking okay with the MACD, the PMOs starting to go up, the PPOs going up. We're looking better here with our longer term tricks in KST. They haven't quite turned positive yet, but they're showing some slight improvement. The chicken money flow, another smart money indicator. We're seeing a little bit of weakness on the daily charts, but it's still positive. That's kind of why it fell down here. And we're getting a rather extreme reading on the daily charts where this is still more positive. We want to see this going up both on the daily chart and here on the weekly chart to be more convinced that the smart money is really coming in and buying. And the chicken oscillator, which had been extreme positive on the daily chart, is actually ticked down, but it's still looking okay here on the weekly chart. The force index is above zero and green. That's positive. The money flow, we're coming down off of an extreme reading on the daily chart where we're just getting to an extreme reading on the weekly chart. We did have an up week, but it wasn't up as much as the week before, but we're still above zero with the 1 week rate of change. We're still looking good here with our 50-week rate of change. We're above this red line here. Now, sometimes that marked a top, but it doesn't necessarily mean that we have to stop there. These lines are just to kind of give us a warning sign. And the RSI is looking extreme. We're above 70 now, so that might suggest that we're a little too positive, but this can last. I mean, we went in this at the end of January, and we didn't cross back below until April. So if this goes up here and camps for a while, that could actually be positive. We still have not turned positive with the weekly chart of the special K, where we remain positive on the daily chart. And we're looking good here with the Stochk RSI. We're above the midpoint and advancing, where we're extreme positive here with the Williams percent R. Now, we can camp up here for long periods of time. So this could suggest that there's good momentum. The ultimate oscillator coming back down after giving us an extreme positive reading. We're seeing pretty much that same thing on the daily chart. The vortex is positive on the daily chart, and we're turning back up and looking positive here on the weekly chart. The Copic curve is positive on the daily chart, and we're trying to cross above the moving average and turn positive here on the weekly chart. We haven't hit any of these lower level support levels, so I really haven't been focusing on this chart. We're starting to turn back up with our longer term equity put call ratio, and it's been all over the place lately. And sometimes when you think of the 5-day chart that I use, you'd think it would be going up or down, and it ends up doing the opposite. But this going up is slightly negative in the longer term. We want to see this decline. That ends up being more positive. And we look at the VIX and then the 3-month average of the VIX and take a ratio. This is continuing to decline, and that tends to be more positive. When we look at the trend with our different charts, we're still going up with the Heiken Ashi. We're still looking good here and positive with the Kegi chart. The Renko chart has the open boxes. That's positive. And the 3-line break is still looking positive with the open candles. The ease of movement is above the midpoint and going up, so that's positive when we look at the 14-week version. We had a couple of new X's drawn in here with the point and figure chart. When we got a little bit above 5,500, that threw this new X in here, but we're still working off of a signal that was generated on May 13th, which was a double top breakout. We're working off of that same signal on the daily chart. And we look at the momentum in the long term with the PPO. It's looking good. We're also showing some improvement in the intermediate term. We declined just slightly in the short term. And then we did start a new cycle on June 4th, and since that time, we've been going up. So we'll have to see if that will continue. We are still looking positive with the Elder's Impulse system when looking at the S&P with the green bars. We're still positive with the parabolic SAR. We're also positive on the daily chart. So these are confirming each other, and I consider this to be a primary indicator. And then looking at the month of June, where we're up 80% of the time, and the return, if we were to stop right now, it would be 1.1%. Looking at the different indexes where we are coming off of recent all-time highs with the S&P, we've been going sideways now and showing some weakness with the mid caps, where the small caps have just been chopping in a range for all of 2024. The Dow is in an uptrend and was able to recapture its 13-week moving average. That's positive after it had been languishing a little recently. The NASDAQ, coming off of an all-time high, still looking good, even though it was unchanged on the week. The NASDAQ 100 was up a little bit, but is still looking quite positive. Here's another look at the QQQs. We did close near the low for the week, but this still is suggesting an uptrend. Now, we're going to be keeping an eye on this. When we go up and then come down and close at the low for the week, that could suggest that things might turn negative going forward from here. We don't know that for sure. We'll be watching it on the daily charts and then see how it bleeds through into the weekly charts. The mid caps are still under the 13-week moving average. They're still in an uptrend here. It would be nice if we could see some more strength. They started to take off about the end of January and were one of the stronger indexes until we started to run into some problems. Now, we are seeing a series of lower highs and lower lows here, and that's a little bit of a concern. So we want to keep an eye on the mid caps. The small caps just continue to chop sideways, even though they're still in a longer-term uptrend. The NYSE, a broad market measure, coming right back up to its 13-week moving average and still in an uptrend. The Wilshire, now this is a daily chart and another broad market measure here, coming off of setting a recent all-time high and well above its 50-day moving average. All stocks continue to look positive. The big software companies not really doing much. They're chopping sideways. We have not seen a death cross here on the weekly chart, but they haven't been going up with the rest of the market. The FANG index just coming off of setting a recent all-time high, but this could be a scary looking bar here because we closed near the low. ARK is just not doing very well. And before I started recording, because I don't invest in ARK, but I know a lot of people that watch these videos do. And the number one holding in ARK is Tesla. And since Tesla's really been struggling, ARK has really been struggling. And we're seeing an actual death cross on the daily chart. Watch the intermarket analysis video for that. And on the weekly chart, we're starting to see a death cross here. And it really has not been participating in this upward move that we saw in 2023 and now into 2024. And this is very disappointing for a lot of people. Looking at a weekly chart of the KBW Bank Index, we're coming back above the midpoint here with the RSI. That's turning a little bit more positive. We did have a little bit of an up week after it had been down, and we're still looking more negative when we look at the momentum, though. And we are seeing money going back into banks. We watch this to see, is there confidence in the banks, and are they paying any higher interest rates because people take their money out of banks and put them into money markets that are giving them a better return. And there's some problems with some banks that we just want to keep an eye on. We don't know if it's going to develop into anything or not. Here's traditional Dow theory on the weekly chart, where we haven't come back and set an all-time high with the Dow. The transports have been going sideways to down. That's really been dragging things lower. We were really shooting up with the utilities, and now we've been seeing a number of weeks of them pulling back. Some broad market measures here. This is the CRB index, where it's continuing to be positive. Oil actually got back up into the 80 range after it dropped down into the mid to low 70s there for a while. Copper is still coming back down after it was really shooting up, but we're still seeing a positive trend here. The dollar is showing some strength, getting back up into the 105 range. It's in an uptrend on the daily chart, and it's also in an uptrend on the weekly chart. This can put pressure on stocks because the stock market likes a weaker dollar. Gold is still pretty much chopping sideways now. It goes up a little bit and all the gold people are all happy. It goes down and they're like, we can rationalize that some way. It's still pretty much dealing with its 13-week moving average, but it's in a longer-term uptrend. Silver is also coming back down to its 13-week moving average and was able to bounce up, but it was down on the week. Looking at interest rates, we're still positive here when we look at the total bond ETF on the weekly chart. Stocks continue to outperform bonds on the monthly chart, and we're seeing a gradual decrease here in interest rates, but over the last few trading sessions, they've been chopping more or less sideways. And on the weekly chart, we still show that we have the US and UK rates at the highest, German rates, and then here at the bottom are the Japanese rates. Some relative studies where stocks have been in first place. Well, we saw a bit of a pickup in oil here, and it's overtaken the first place position again. The black line are stocks, the gold line is gold, the green line is the dollar, and the blue line here is bonds based on price. They're the only negative asset going back to the beginning of 2024. We look at the NASDAQ 100 and compare it with the S&P 500. It came really close to setting a death cross with this ratio. Then we saw this real pickup with the NASDAQ 100, and it's continuing to outperform, even though it ticked down a little bit with this ratio this past week. The S&P 100 has been really outperforming the rest of the S&P 500, but it's been pulling back. We look at a growth to value ratio. Growth is showing some improvement, and this is one of the potential areas of strength that is coming back into the market. Excuse me for having to keep clearing my voice here, clearing my throat. We did pull back with this ratio, but it is in an uptrend showing that growth is outperforming value. And gold is actually now starting to underperform the S&P, but it's still in an uptrend with this ratio. And gold is kind of chopping around sideways after it had broken out when you compare it to the dollar. Bonds continue to underperform stocks. And we're seeing that on daily charts. Here's a weekly chart. And then we also looked a minute ago at a monthly chart. So we're seeing that across the board. And this is bonds based on price. The low volatility stocks continue to underperform, even though they ticked up just a little bit this past week. Discretionary to staples, we want to see this doing better, but we've seen a recent death cross here on the weekly chart. If this can get back up and we can see a golden cross, that would be more positive when we compare it to staples. And then energy ticked up just a little bit when compared to tech, but it's still been underperforming in the longer term. Then we have our NYSE breadth thrust, and I show this every week, but the signal that we really bounced off of was set back in October of 2022. That's when this got a really low reading. And since that time, we've been in a positive environment. And this is the ZWAG NYSE breadth thrust. We came within about a day or so of having this be triggered. It's still positive overall, and we're still working off of the signals that were generated earlier on here. And then there's the Horchak method. This is a long-term buy signal that still remains in force. This is a long-term chart, a weekly chart of the S&P. We're still above this trend line going back to the 1987 crash. This is a further blow up, and at some point I'll extend, excuse me, I'll extend this trend line out, but we're well above this, so I haven't been going in and changing that yet. We're still positive here when we look at the new highs minus the new lows on the NYSE. This is a 50-period moving average. This is coming down. We want to see this turn go back up, but we are above zero. Then we look at the S&P 50-day new highs minus the new lows. This is also barely starting to turn back up, but we're still above zero. To have this turn and go back up would be much more positive. If this continues to decline, naturally that would be more negative. Here's a weekly chart of the NASDAQ 100. We're well above this trend line going back to 2009. And this is a chart that I've been showing, and I'm not quite sure what the perma bears are doing about this. I've mentioned this quite a bit now in a number of different videos. We hit a real high ratio with the NASDAQ to Dow back in 2000, and then we just tanked after that. We came up to the same level at the end of 2021, and then bam, we had a real difficult 2022. And we were coming up to this level, and these bearish folks think that this is the holy grail to what's really happening in the market. Well, now this ratio is going up. So how are they going to cause their rationalization to be impacted here? I'm sure they'll find some way, but I don't see these folks doing a lot of videos lately. And we're seeing that same thing here with the QQQs, which is the NASDAQ 100 compared to the IWM, which are the small caps. It came down a little bit, but we're still above this blue line, which is where they thought everything would top out. And by they, I mean the perma bears. And yes, I like to rank on them because no matter what information, no matter what evidence you tell them, they're still just sure that the market's going to fall apart and it's just around the corner. I'm not a perma bear. I'm not a perma bull. I like to be a perma realist. Semiconductors also breaking above these previous levels, even though it did come down slightly this past couple of trading sessions. We're going flat now with the cumulative new highs minus the new lows for the NASDAQ after it had been declining for years. It was starting to go back up, but now it's going sideways. We want to see this go back up to be more positive longer term. We want to keep an eye on this 3-month ratio. It's been going sideways. This is what happened when the great financial crisis unfolded, is we just saw this massively go down. It hasn't been doing that yet, but we just want to watch this. And then we have this thing called the Hindenburg-Ullmann. If you want to pause this, I'm not going to go through and read all this to you, but this is a fairly good explanation of how it all comes together. We did not get a confirmation signal with the Hindenburg-Ullmann here. It was actually, I think it was June 18th. I should have used a different chart here. That was the end of the 20 trading days. Well, we're after the 21st now, so this is not a confirming signal. But we've been getting lots of confirming signals when we look at the NASDAQ. But here we have these confirmed signals here, and look what the NASDAQ was doing. And then, in fact, the only time it wasn't generating a confirmation is when the NASDAQ was going down, and it just keeps generating these signals as the NASDAQ keeps going up. That's why I never use one indicator all by itself, but the perma bears just love this thing. They've been just salivating, waiting for this to kick into gear, and it doesn't seem to be happening. Seasonality. This is Dan Bird's chart. He sends out a weekly email that's free. The link to that is in the description below. We're focusing on the June area right now, where we could be coming into the latter part of June, where we might see some negative seasonality and then a nice little bump up right at the end of the month. And we're seeing that on different charts too. This is a longer term look. This is going from 1982 forward into 83 and 84, where the market performed really well. And we've been doing that. We were doing good in 2023. We finally bounced up from the October 2023 lows, and we've been pretty much going up since then. June tends to be a positive month on a performance basis, going back to 1950 during an election year. We're up 15 out of 18 times. We're down 13 out of 18 times with a 1.3% return. And then June does okay when we look at the monthly returns going back to 1950, according to this chart. It is positive, but nothing necessarily gangbuster here. Where when we look at it on a world basis, so stocks not only in the US, but world stocks as well, June tends to be one of the more negative months. And then I blocked out another area here. When I first started showing this chart, it was sell in May, and because that tends to be a pretty negative time for the market. But we ended up having a pretty good May. And then now we're looking at June to November, where it's a little bit better, where we see the average percent change 3.4%, and we're up 67.6% of the time. When we look at the summer months, June tends to perform well during election years. July, not up as much, but still positive, and August tends to do well also. And here's some charts that I've been showing. These are seasonal patterns put out by the Stock Traders Almanac. This is a little bit out of date with this pinkish purple line here. It would be a little bit further along. But we look at the top first quarter during election years. We're wondering if that's the seasonality that the market's going to follow. And it's not straight up, but it tends to be up overall. And then we can compare it with other times along the way here. This gets a little bit confusing when you have all these different colored lines going on. This is also a bit out of date. This is looking at the pattern during an election year. What I'm focusing on is June going forward, where we tend to be positive. But you see how we dip down as we get a little bit closer to the end of the month. We also have a good start to July, and then it tends to trail off as we get closer to the conventions. And then we see a good start to August, and then it also trails off. When we really start to kick back into gear during an election year is when we get into September. And then looking at the NASDAQ, where we are pretty much flat for June, we actually see a bit of a decline in July, and then August going forward tends to be positive for the NASDAQ. And then they're trying to make a comparison here with 2012 to what's happening right now. We've been kind of following along with that. It looked like we were first going to follow with 1968. Well, we deviated way away from that. So if we continue to follow the blue line here, we saw some weakness and then some strength in May. June tends to be pretty good before we see some weakness, and then we see July being pretty choppy before we see a little bit more strength going into August. Looking at the different way from Bank of America, where June tends to be good, July is even better, and August is even better than that. This is during the fourth year of a presidential term. So you can take the same data and just arrange it a little bit differently and get completely different results. That's why I don't rely on just one chart here. And I don't use this to make decisions. I just use it as a guideline. Where, according to Carson, when we look at all the years going back to 1950, we're kind of positive. The past 20 years, we've been kind of negative. The past 10 years, we've been positive, and during the election years, when we tend to perform the best. And this also is confirmed here by Carson, where we're up about 75% of the time in June with a 7.3% return, going from 1928 to 2020, showing how June, July, and August perform. This has been updated here. This is showing what we're currently doing with the S&P. I put the red area around what's happening in June. We actually tend to perform better when it's not a presidential election year, where we might see some weakness going into the latter part of June. And then the first half of June tends to be positive. The second half of June tends to be one of the more negative times. And then here's the last seasonal chart. This is how we've been performing so far. We're in this yellow area right now. This is the overall trend, and it says we're still in the sweet spot for seasonality. Doesn't mean we go straight up, but June, July, August, and September during an election year tend to perform pretty well. Thank you. I really hope you found this helpful. I hope you're having a wonderful weekend, and I will talk to you in the next video.